Have you got your 5 stocks from Webull yet? If not, check out the link in my description box. All you have to do is deposit any amount of money and we each get 5 stocks. It's that simple and you only have a couple more days to do it, so get on that. Get your 5 stocks, link down below. Now let's get into the video. Alrighty guys, first and foremost, Merry Christmas, Happy Holidays, Merry Christmas Eve. Hope you guys are doing very well out there. And in this video, I just want to hop in very quickly, say hello, and of course, we're going to be breaking down some stocks. Like you guys saw in the title, we're going to be going over 2 beaten down stocks that I'm going to be buying in 2022, and I actually already own these. I own both of them, and I've been buying them for months. So if you guys find value, hit the like button, subscribe, check out my Patreon, link down below. If you guys want all my buys, sells, call outs, morning update videos, plus more, all of that's on Patreon. And with that being said, I don't want to be too long today, so let's get right into the video. Stock number 1 is none other than, drum roll please, it is Alibaba. And before you guys click off, before you hit the dislike button and be like, oh Stas, another Chinese stock, what are you thinking? All of these are getting delisted, all of these are going to zero. Before you do that, let's talk a little bit about Alibaba. We'll take a look at some numbers, and of course we're going to talk about some charts, break down some charts, and talk about the risks involved. So first and foremost, the risks involved. There's a lot of risks involved, right? I'm not oblivious to that. The risks include China, right? The Communist Party over there in China, they can literally dictate whatever they want, right, in that particular country, in that economy. We all know that. We all know that they have a lot of power, right? So that's number 1. Number 2, delisting. We're seeing some Chinese stocks getting delisted. So that is always a risk, right, lingering in the back of everybody's mind. This might get delisted. I think it's a small chance, but there is a chance it could get delisted off of the U.S. markets, right? That's number 2. Number 3, regulation. There's regulation issues, right? We know that at this point, and there's a lot more risks involved with Alibaba, but I would say those 3 are the most important. Delisting, China in general, the CCP, and of course, regulation. So we understand that, right? Alibaba is going down because of these risks. It's not like the business is failing. In fact, it's growing. We'll take a look at that in a second. The business is growing. So the reason why it's going down is because of these risks, right? I mean, it's gone down from $319. That was back in, when was that? October 2020. It went all the way down now to 108 recently, and now it's trading at about $118. And full disclosure, all you guys in my Patreon know, I've been buying this thing. Like I said in the intro, right? I own both of these stocks, and my average cost in Alibaba right now is about 165, maybe 170 bucks, and I'm looking to bring that down a lot more heading into this brand new year. So when you're looking at stocks in the stock market, guys, realize there's always a reason as to why they're going down a lot or they're going up a lot, which again, we covered why Alibaba has been going down a lot as of now. And now that it's been going down a lot, it was once a close to $1 trillion market cap. Maybe it did break that momentarily. But right now, the market cap is $321 billion. It's crazy how much smaller this market cap is than, let's say, some of the big tech giants in the United States. We're talking Apple's over $2.5 trillion. Google is up there over $1 trillion, $1.5 trillion. Microsoft, these businesses are massive. And if you compare Baba to the tech giants of the U.S., it is very small compared to them, right? It's crazy. Again, $320 billion market cap, and the PE right now is ridiculously low, 16.68, trailing 12-month PE, $7.11 trailing 12 months EPS, and $127 billion of trailing 12-month revenue. So they make a lot of money on the top line and bottom line. Their PE is disgustingly low, and the market cap, in my opinion, is very low as well, which is why I want to be buying more of it, and I already have been buying, like I said. So let's take a look at the revenue numbers quickly so I can show you guys, prove it to you, that they have been growing hand over fist over the past couple of years. So let me scroll down a bit here and I'll show you guys. So take a look here, guys, and ignore all the ads on the right here. I don't know what the heck these people are trying to advertise, but overall, take a look here. 2021, 2020, 2019, 2018. So we have 4 years of data right here. And you guys can see in 2018, they did about 37, almost 38 billion in revenue. The following year, 56 billion. The year after that, 73 billion. And now in 2021, up until I think recently, about $106 billion. So this business is growing, guys, 20-30% every single year, some years more than that. So for a P to be at a 16, that's very undervalued. And again, there's a reason why it's undervalued. Like I said earlier, there's a lot of risks. And when I pull up this balance sheet, let's take a look at assets versus liabilities. You guys can see right now in terms of cash and short-term investments, that's sitting at just under $80 billion, and their total current assets, I like looking at current assets over current liabilities. Their current assets right now are sitting at about $98 billion, and current liabilities, let's see here, where is that? About $57 billion. So what that's telling me is they're able, if they wanted to take all of their cash, they can take cash and short-term investments, liquidate whatever they have to do in the short term. They can pay off all of their current liabilities if they wanted to, right? So they have a lot of cash, more current assets than current liabilities. That is very good. And again, I'm looking to buy more of Alibaba in 2022. And I'm not telling you guys what to do, but for me, I'm buying this with an amount of money that it's not significant to the point where if I lost a good amount of it, I would be devastated. But I am putting a decent amount in, a small percentage of my portfolio because I do believe, again, this company is undervalued. So stock number 2 is DraftKings, guys. Ticker symbol DKNG. And just look at how beaten down this particular stock is. It was $74 back in the middle of March. Now it's sitting just under $30 per share, and it actually got all the way down to $25 per share. So from 74 to 25, this stock went down about 65%, which is pretty crazy. I mean, whenever a company goes down that much, in my opinion, it's worth taking a look at. The market cap right now is $11.96 billion. They have a 0 PE because they don't make any money. They don't have profits. So if you don't have profits, you can't have a price to earnings ratio, right? Because there's no earnings. In fact, there's negative earnings. They did about negative $3.62 in EPS the trailing 12 months. So they're losing about $3.60 per share. And when it comes to trailing 12 months revenue, they did about $1.14 billion. And for me, guys, this is the best company when it comes to sports betting, online gambling, and they just acquired Golden Nugget Online Gaming, which, in my opinion, that was a very good acquisition. It was pretty smart on their part in terms of DraftKings to buy them out, all-stock deal, because that company specializes in iGaming, right? A bit different from what DraftKings does, and them two together, I think it's very strong. It makes, the products that DraftKings now offers stronger. It makes them better and a bit more diversified, right? So in my opinion, the brand name for DraftKings is there when you're looking at sports betting across a lot of different professional sports leagues. DraftKings is it's the biggest player, and of course there's a lot of competition. There's a lot of businesses coming out with their own platforms. We have MGM, Wynn, we have Penn. There's just so many. FanDuel. There's a bunch out there, but again, the brand that DraftKings has built, their moat, I think it's pretty strong. So I'm an investor in DraftKings right now. I sell covered calls on my position. I'm running the wheel on this stock as well, and I'm planning on doing that a lot more in 2022 to create income while I'm holding the stock. So let's go over and see how they're doing financially, how they're growing, and what their assets over liabilities are looking like. So let's go back to the CNBC tab. Alrighty, guys, so take a look at this. We have 4 years of data from 2017 to 2020. So in 2017, they did $191 million of revenue. In 2018, they did $226 million, followed by $323 million in 2019, and in 2020, they did a whopping $614 million. And I don't think I said this before, I might have, but in the trailing 12 months, they've done over $1.1 billion in revenue. So pretty much they've doubled up what they did in 2020. So this business is no joke growing. From 2017 to 2018 to 2019, it grew about, 30-40% a year, maybe a little less, a little more. But in the past 2 years, it's literally been growing 75 to 100% year over year. This is crazy when it comes to the top line. And let's take a look here. Again, like I said, there's no earnings. They're losing money, so we don't have an EPS to look at. But we can look at their balance sheet and see what's going on here. So let's see here. We have cash and short-term investments sitting at about $2.1 million. So not a crazy amount of cash, not a crazy amount of current assets. We have current assets sitting at about $2.19 million, so nothing too crazy there. But when it comes down to their current liabilities, it's not much either. We have $500,000 of current liabilities, which is really not much. So they have more than enough current assets. They have more than enough cash to pay off their total liabilities and their total current liabilities. So their balance sheet looks fairly good, in my personal opinion. We have, again, total liabilities at about $740,000. Total debt, or rather current liabilities, $550,000. So pretty nice balance sheet here, and they'll probably beef up their cash position and short-term investments over the next couple of years. That's what I'm assuming here. So overall, guys, look, this company's growing. You're going to have to pay a decent multiple. In this case, there is no P, so there's no price to earnings, but price of sales is a bit higher. So you are going to have to pay a premium for this company. And I think now that it's down 65%, in my personal opinion, now might be the time to consider that. So overall, guys, look, this is all my opinion. I'm buying these stocks. I've been buying them, and I'm going to be holding them for a while. And as always, you must always do your own research. I'm not a financial advisor. This is only my opinion. You guys must understand that. So with that being said, I'm going to wrap the video up here. Make sure to hit the like button, subscribe, drop a comment. Check out my Patreon if you guys want all my moves in the markets. And you could also get 5 stocks from Webull, which, again, like you guys saw in the beginning of the video, it's limited time, so make sure you get your 5 stocks, link down below, and your $50 from M1 Finance. And with that being said, I'll catch you guys later. Merry Christmas Eve, happy holidays. I appreciate all of you guys. Keep crushing the market. Stay safe out there. Peace out.